Okay, well, today we had to start the audit and assurance, and here let me take you from the scratch. Okay, first you must understand that we have a company. Let me write here. This is a company, okay, and this company is owned by shareholders. Okay, this company is owned by shareholders, right? And the company is run by board of directors. You can call it board of directors. Clear? So the company is the artificial legal personality. Artificial legal personality. Okay, and this company is owned by the shareholders and run by the board of directors, right? Now here we have you can say two relationship between the shareholders and the board of directors. So it means that we have here the relationship between shareholder and board of directors, and this you may say like that we have two relationship built or established between the board of director and the shareholders. Okay, before starting that, before discussing that relationship, we have first to understand that why we are doing auditing. What is the objective of the auditing? So first we have to clear that objective of audit is that auditor must state an opinion as to whether the financial statement give true and fair view, accounting records are accurate and complete, and are prepared in accordance with applicable financial reporting framework in all material respect. We have to understand these objectives. So for understanding these objectives, we have now to understand that what are those relationships. And I told you before, the first one relationship is agency relationship. Okay, and the second one is, you can call it stewardship. Okay, so the company is owned by the shareholder, okay, and run by the board of directors. Now the shareholders are the principals and the board of directors are the agent. Okay, let's come here and see here. Let me, okay, here I will just write here for you that you see. We are here. You see, this is these are the shareholders. Okay, and this is the company, and these are board of directors. You see, now the shareholders own this company, and this company is run by the board of directors. So the relationship between shareholders and board of directors, there are two relationship between shareholders and board of directors. The first one is agency relationship. Right here, agency relationship. And the agency relationship, we have principal, and the second one is agent. Okay, now the principals are here, we have shareholders, while the agents are the board of directors. It means that the principal allow agent to perform contract, okay, and activities on behalf of the principal. So means that these board of directors, here the board of directors run the company, and they are doing contracts and other activities on behalf of the shareholder. So shareholder are principal and board of director are agent. In this context, they make a relationship that is called agency relationship. Now the second relationship, I will let me write here. This was the first relationship, what that was a agency relationship. Now the second relationship between these shareholders and the board of directors are called stewardship. Let me write here stewardship, and you know these are the stewards. Stewards. Okay. So what is the thing happening? You know, the shareholders or owner due the asset and the properties to the board of directors, and at the end the stewards mean the board of directors accountable for those assets which was given by the shareholder. Means the board of directors are accountable for those assets, for the utilization of those assets. So the relationship built between on this context, it will create a stewardship relationship. Clear? Now, you know the board of directors run the company, and definitely they have to be accountable for their actions. So for that purpose, they will make some documents. They will prepare some documents, and those documents will be presented to the shareholders. Okay, here you see these board of directors. Okay, they will prepare some documents, and those documents we call is financial statement. Okay, and this financial statement are prepared for whom? This for prepare for the shareholder. Okay, now the shareholders they have to rely on these documents, but before relying on these documents, the shareholder need someone independent, because you know the board of directors run the company, plus they prepare the same documents for the company. So definitely they will not write, or they will not present such thing that is against the board of director. So for that purpose, the shareholder want to rely on this document. So they want to hire someone, and that person should be you know that person will review or check or audit these financial statement, and will give has opinion on that okay, these financial statement are okay in all material respect. So they have to put their opinion there. So for that purpose, the shareholders hire a person, and you know that person should be a third party. Clear? They will be those people should be a third party who will check on this financial statement. The second thing, these must be neutral, means they should be neutral in all aspect. Then they should be independent, mean they should they not dependent on anyone, because if they're dependent on someone, then definitely they will the opinion will be biased. The other thing, this person should be have you know impartial, same like that, and should be knowledgeable, mean the person who is checking these financial statements should have knowledge about the financial statement. If they don't know about the IFRS 16, then how can they understand that whether the depreciation is okay or not? So for that, there should be a knowledgeable person. I mean, there must be some characteristic. There must be some characteristic which will. Okay, now these. Let me create. Okay, so if the person who have these characteristic, we call that auditor. Okay, and you know the auditor must be a third party, neutral, independent, impartial, and have knowledge. Third party means that there should be not the person from the board of directors, or from those who have some familiarity with the board of director. This should be third person, and this should be neutral. I mean, they will not take side of the board of director, neither they will take side of the shareholders. They should be independent, means they have they should be not any sort of conflict of interest, and they should be impartial, knowledgeable. Okay, now if the person have this characteristic, this person we call auditors. Okay, and the auditor will come and will check the financial statement. Okay, So once they check the financial statement, then they will put their opinion on the financial statement, and that opinion will be for the reliance of the shareholder. So shareholder then will rely on those financial statement. And you know that financial statement, we have statement of financial position, we have income statement, statement of change in equity. So these financial statement will be audited by the auditor, and then the shareholder will rely on that. Clear? Now there's some definition. Before we gonna move forward, we have to discuss the definition. And before definition, let me clear here that the objective of the audit is that the auditor, mean the person who is independent or parties and knowledge about the financial statements, must state what opinion as to whether the financial statement means the document prepared by the board of directors, and these documents are prepared for whom? These are prepared for the shareholders. Okay. And what will be the opinion of the auditor? The auditor will say whether these financial statements, these documents are give true and fair view. We'll discuss this later, that what is true mean and what is fair mean. The second thing, this must be the accounting records are accurate and complete. Means the accounting records are accurate and complete. The third objective of the audit is that whether the financial statement prepared according with the applicable financial reporting framework, like International Accounting Standard, IFRS, and they should in all material respect. Material respect means that the thing is material. Let's say a person who has the ability to earn 1,000 for a day. So $1 is $1,000 is the ability of the person to earn per day. So $1 is immaterial for him. But if he lost, let's say, $5, so that will be a material amount for him because it's a big amount. Now let's say we have some general principle of the auditor to follow, or the principle that auditor should have followed. The first one is should compliance with the applicable ethical principles, ACCA Code of Ethics and Rule of Professional Conduct. They should compliance with the international standard on auditing, ISA, and then they have to keep the professional skepticism attitude when performing and auditing, when performing and planning the audit. Means they don't accept the face value. They have to get evidence. On the basis of evidence, they should give their opinion. Okay, this is just the principle for the auditor, and the first one is the objective of the audit. And then we have some definition which I have explained before, that what is accountability, what is stewardship, and what is agency. So starting from the accountability, this is the definition that accountability, what does it mean? It means that holding those in charge accounting for their actions. Means the person who is let's say a person is a storekeeper. Okay, so he will be responsible for the stuff inside the store. So I mean he is accountable for the product or the stuff which is in his control, which because he is in charge of their thing. So accountability means that in the context of the company, the board of directors is holding the asset, okay, and manages the asset of the company, which is the you say that the shareholder, the product ownership is belong to the shareholders. So the directors will be accountable for those assets. So holding the directors means that holding the director who manage the company responsible for explaining their action, whatever the action they take, so they will be responsible for that action to the shareholder, because shareholders are the owners of those assets and who own the company. So it means that the company, and in context of company, the board of directors means those directors which are responsible, who manage the company asset, will be responsible to explain their action to the shareholder. Then we have the stewardship, and I told you that stewardship in simple terminology, you can say that when a person is responsible for taking care of something on behalf of another. I mean, a person who, let's say, here's a person, this is a person, and you put something with him, okay, so he is the steward and he will be responsible for the thing which you have which for the thing which he is caring about, because of you and because of someone, okay. So in that context, in case of in context of the company, the directors and the shareholders, so there's a relationship between the stewardship, because directors are responsible for the management of the shareholder properties. I mean, the properties owned by the shareholder, but the carrying responsibility for those assets is for the directors. So there's a relationship between the directors and the director and the shareholder. On that base, we call that stewardship, because they are the stewards and they are responsible for the management of the property which was given by the shareholder. And the last one is we have the agency relationship. And agency relationship, there are the two elements. The first one is agent which act on behalf of the principal to perform a task for them. So this, in context of the company, company is owned by the shareholders. So shareholders are principals, and on behalf of the shareholders, the agent, the directors, do some contract, that they do some activities. So on that basis, the relationship between the directors and the shareholder, we call that agency relationship, okay. And this is simple. You see here, you see the company, the director are the agent of the shareholders, mean shareholders are the principals who entrusted them to manage the running of the business. So this is just the definition. We have discussed some objective of the audit. We have discussed the general principle for the auditor to follow. We have discussed that what quality the auditor must have. And then we have also discussed some stuff like financial statement. Now, if you see assurance engagement, so assurance is a bit of level up satisfaction. This is the, okay, here, let me write it. This is a level of satisfaction, okay. So there are there's a 5 elements of the assurance engagement. In the first element we have is a tri-party relationship, and then we have subject matter, okay, subject matter. Then we have you can say like criteria, or you can say like yardstick. And the fourth one we have evidences, and the fifth one is actually the report, okay. Or let me explain one by one. What does a tri-party relationship means? In a tri-party relationship we have 3. Let me show you here. You see there, this is the 3 user error assurance project needs. So the first one is that in a tri-party relationship, the first one is intended user. Intended user means those who want reports, and who wants the reports? The shareholder actually wants the report. So the intended user is those people who want the subject matter, who use the subject matter, right? And the second one here is responsible party. And responsible party, the person who provides the subject matter. If we take the example of company, then you see the subject matter. Here we have financial statement, clear? And this is the subject matter. And who prepared the subject matter? The responsible party. And who is responsible for preparing the financial statement? And the responsible party is the board of directors. Board of directors prepare the financial statement. And who want the financial statement? So the intended user, and intended user includes the shareholders as the shareholder. Shareholder wants the subject matter, and the subject matter is the financial statement. Okay, then we have a practitioner, and you know what is practitioner? Practitioner is a person who review the subject matter and provide assurance. So this subject matter is reviewed by someone, and that person we call practitioner. In case of company, we call them auditors. And why the auditor review the financial statement, and these financial statements are reviewed for whom? These financial statements for review for shareholder. For what? Because shareholder will this will provide assurance to the shareholder, and the auditor will give opinion on their financial statement, which is prepared by the board of directors. So this is the tri-party relationship. The first one we have here is the board of directors, means the responsible party, and then we have intended user, the shareholders, and then subject matter, that is called financial statement. As the example, subject matter, what would be? So this is just example in case for the company. Okay, now you see the subject matter, the material provided by the responsible parties, which needs assurance on, we call that subject matter. In case of the company, this is the financial statement. The financial statement are those material which are provided by the responsible party, means the board of directors, and which need assurance because the shareholder want some reliability to rely on their documents or those financial statement, and we call that subject matter. And then we have some criteria, because the subject matter can be assessed. So there must be some criteria, and the criteria is like IS, IFRS, on the basis of that IFRS, IS, this subject matter is prepared. So this is so the subject matter can be assessed, and there, because auditor will assess the subject matter on the basis of those criteria. There must the practitioner will obtain some evidence. This are obtained by the practitioner. The evidence is obtained by the practitioner, and so give assurance. So the practitioner will obtain some evidence. On the basis of evidence, they will give the assurance to the shareholder. And at the end, they will provide the report to the intended user, the responsible party, from the practitioner. I mean, the practitioner will provide the reports to the intended user who want the report. So these are the 5 elements of the assurance engagements, and we have discussed. So let's move on, and we have here is the definition, and let me take you to the definition, that what does the audit actually means. So if I write here, let me take you from here. Okay, so it means that audit. So audit is actually an independent and defendant examination of what? Examination of financial statement to express an opinion on those financial assets, whether it is prepared or it is present through a fair view in all material respect. Okay, in all material respect. And you must also understand that auditor provides reasonable assurance, means they will not provide a guarantee. Okay, reasonable assurance to the user of financial statement. So these are two terms. What is true and fair means? Fair means that it should not be biased. It should be unbiased. Clear? And the true means something based on facts. Let's say if the balance sheet show or present property, so the property should exist and actual. That is called true. So I think we have discussed the definition of the audit. We have discussed the assurance engagement elements, that what is insurance, subject matter, and so on, agency, and we will continue like that in the upcoming lecture. Okay. So for today, I think this is enough. Let me, and this is our first lecture. Okay. This is the lecture number 1, and we will meet in the another lecture. Okay, so thanks for watching.